and welcome to the Rategain Travel Technologies Limited Q4 FY2022 earnings conference call. As a reminder, all participant lines will be in listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Bhanu Chopra, Chairman and Managing Director, Rategain Travel Technologies Limited. Thank you, and over to you, sir.
Thank you very much, and good afternoon, everyone, and thank you for joining the earnings call for Rategain Travel Technologies Limited for the financial year ended March 31st, 2022. We're very excited to meet all of you again and share with you how the last 1 year has been, what is driving growth for us, and where we are headed. Joining me on the call are Mr. Tanmay Das, the CFO of Rategain, Mr. Ankit Chaturvedi, our Global Head of Marketing, Mr. Thomas Joshua, Company Secretary of the company, and alongside we have our investor relations partner, Strategic Growth Advisors. So we announced our annual and fourth quarter results yesterday, and I hope you've had a chance to go through our financial results, press release, and investor presentation that are available on the stock exchanges and on our company website. So as we start, it is important for everyone on this call to understand what we have really achieved in the last 1 year. So there are very few years in the entire trajectory of a company when you go through multiple transformations. And FY22 will always be a special year in the history of Rategain, as it stands as a testament what a culture of collaboration, nurturing talent, and innovation can achieve. So a few high points that I'd like to share with all of you. First off, on a run rate basis now, we're exceeding our pre-COVID annual recurring revenue by 8%, which was last achieved in fiscal year 20, which was pre-COVID, and so it is the highest in the history of the company. We launched 3 new industry-leading products completely built in-house, powered by AI to serve the new use cases as the industry moves towards digitization, and we see very good adoption across all of these products. We now have an end-to-end digital marketing platform under our MarTech business to help hotels drive higher ROAS and brand engagement. One of the things we talk about is always our ability to mine our large customer base, and we were able to do that this year and improve the penetration in this customer base, and I increased our revenue from existing customers by 14%. So for those of you who are joining us for the first time and would like to understand more about Rategain, we are a provider of SaaS solutions that work with close to 2,400 travel and hospitality companies to help them maximize revenue through AI-powered SaaS solutions. Every day, our solutions are used by the leading 23 of 30 hotel chains of the world, the 25 out of the top 30 largest online travel companies of the world, all the leading car rentals of the world, airlines and tour operators to engage, acquire, retain guests, and also drive wallet share expansion with them. So our business internally is aligned around 3 major segments. Data as a service that provides competitive insights around pricing, demand, and now also we have an end-to-end pricing platform. Our second business line is distribution that provides connectivity to our customers, that is hoteliers, to get travel demand from OTAs as well as GDSs, which are the traditional travel agent system. Our third business line is MarTech, which is the end-to-end digital marketing platform to digitally acquire customers, elevate brand equity through brand education, awareness, and engagement. So now let me also talk about the global travel health. So as we all know, COVID has now really entered the endemic stage. If you think about it, all of us are traveling now, and the impact of COVID seems to have subsided and entered the endemic stage. So it has really been impacted given the changing attitude towards COVID. So if you look at earning reports from leading hotel chains and our own numbers, we're seeing that leisure travel is touching 2019 levels, and in some cases it's being reported that leisure travel is actually higher than 2019 levels in certain key markets such as US and Mexico. So as we had indicated earlier, US was first to open, but because of the booster vaccination programs in Asia and European countries, it has really helped international travel resume, and we're expecting the 2022 summer to help in accelerating recovery and go beyond 2019 levels in these regions. The conflict in Europe continues to have lesser impact in deterring travel plans, as Western and Central Europe are seeing a 500% increase in bookings on our systems despite of hotels and airline prices also rising. So some of the macro level economic changes that are impacting the industry that I've touched upon earlier as well, and I would like to revisit. There is a structural shift happening in our industry. We've all heard of the Great Resignation in US. There are labor shortages. And also, just like other industries, we are seeing a faster digital adoption in travel and hospitality. So thus, we see acceleration of adoption of our new AI/ML-based products. This has really been the heart and soul of what we've been working on, and see acceleration of new product development at Rategain. This is also helping elevate the positioning of the company as an innovative leader for the industry to capture this revenge travel demand. We continue to focus on innovation and working on solutions to help our customers engage better with guests and also lead to wallet share expansion. I'll be happy to share more on this in upcoming quarters. So now let me take you through each of our business lines. So I'll start off with MarTech. The MarTech business unit has a recurring revenue of 98% and now contributes 33% of our overall revenue. Growth has been driven by an increase in existing volumes in our meta search product, which grew by 175% year on year on net revenue. The business unit continues to see considerable demand for its meta search offerings as more hotels try to optimize costs, improve ROI, and generate direct revenue through meta search platforms to reduce cost of customer acquisition. FY22 was a year when our MarTech division really recovered from the pandemic and delivered the biggest sales in the history of the division. The immediate focus of the company is to continue to build on this momentum and increase penetration in our existing client base as we look at building an end-to-end digital marketing platform which will allow hotels to get a unique platform, manage and drive performance across all digital channels. It's the only platform that allows both connectivity and optimization to meta search channels, and this is also our 10x differentiator against our competition. It's the only platform that uses demand forecasting data to provide smart insights to improve return on ad spend. Our distribution business segment also continued to grow with recurring revenue of 97.2% and contributed to 38% of the revenue in fiscal year 22, with our volumes now even higher than 2019 levels. We enabled 50 plus new pairings between existing supply partners and demand partners, which helped in driving growth. This included connecting the top 5 hotel chains of the world to regional leading OTAs such as Rakuten, as well as new emerging OTAs such as Hopper, that is now the fastest growing mobile first travel application in the US. The DaaS business unit registered strong growth in its airline and OTA customer segments on the back of acquiring marquee customers as well as expansion of volumes in our existing OTA customers. We saw one of the largest hotel chains in Latin America, Caesars Entertainment in the United States, one of the top 10 airlines in the US, and many more. The recurring revenue for this business was 97.1% and contributed to 29% of the revenue in FY22. Rategain's new AI-powered products, RevAI, Content AI, and Demand AI, launched as part of RG Labs, have backed leaders in their respective segments. Content AI and Demand AI have been selected by one of the largest operators of hotels in Germany and one of the largest hotel chains in Spain, respectively. RevAI continues to onboard car rental franchisees to solve the problem of automation and revenue maximization, and was also selected by Budget Rental Car's largest franchisee in the United States. In terms of awards and recognition, our people, our products, and our commitment to our customers have all been recognized this year, making FY22 the biggest year in terms of award wins as well. We were recognized by both Booking.com and Expedia.com as a premier and preferred connectivity partner. We achieved the distinction with Booking.com for a fifth year in a row. We continue to show our excellence in innovation by winning 4 awards for Demand AI, Content AI, and PCV at the recently concluded HSMAI ADN Awards that recognizes the best technology and talent from the industry. We won top honors at Hotel Tech Awards, which recognizes the best products voted by over 100,000 plus hoteliers, and came in as first runners-up in Rate Intelligence, Parity, and Channel Manager categories, as well as finished as one of the most loved companies of 2022. On the people front, we were recognized as a great place to work for a third year in a row and awarded as the best employer brand as well by the World HRD Congress. I'd like to now ask our CFO, Mr. Tanmay Das, to take you through the performance of the year.
Thank you, Banu, and a very warm welcome to everyone on this call. It has been a strong quarter and a historical year for Rategain. Our strong fundamentals and steady improvement in key KPIs is a testament to our business model. Rategain's performance showcases how new-age tech companies can drive growth as well as profitability in a tough macro environment. The global environment is improving in favor of travel, even though macroeconomic uncertainties continue to persist due to multiple factors. However, high demand shows the industry has grown resilient. Due to seasonality of our business, due to travel booking patterns throughout the year, it's more relevant to see year-over-year performance rather than quarterly sequential performance. Talking about the financial highlights of Q4 FY22, our top line registered a growth of 51% year-over-year. Adjusted EBITDA margin achieved was 11.7%, registering a growth of 66% year-over-year, indicating margin expansion due to growth. The growth was aided by 101% growth in new contract wins compared to the same quarter in the previous fiscal year, and some large contracts signed in each of our businesses. The EBITDA margins of Q4 was higher than expected by 50 basis points due to delay in hiring few positions, which will spill over to Q1 of FY23. On similar lines, the revenues for FY22 registered a growth of 46% over FY21. Adjusted EBITDA margin improved to 10.3% as against 9.4% in corresponding previous year, registering a 59% growth. After 2 years of negative PAT reported, we returned to a positive PAT this year, registering 116.1 million and 84.2 million PAT for Q4 FY22 and FY22 respectively. The adjusted PAT after adding back amortization of acquisition cost stood at 117.8 million, which is 16.5% of revenue for Q4, and 317.9 million, which is 8.7% of revenue for FY22, registering multifold growth. Our revenue model remains highly predictable, scalable, recurring, and resilient. The gross revenue retention is 90%, while the net revenue retention stands at 114%, indicating lower churn and expansion of our existing relationships. The recurring revenues across all our businesses range from 97 to 99%. 75% of our revenue came from subscription revenue. Leisure travel dominated the revenue by type of travel, standing at 95%. US remained our largest market with 62% revenue contribution, followed by Europe at 24%. Another metric that we feel extremely proud about is our LTV to CAC ratio, which stands for far above the industry benchmark at 12.9, which improved from 11.9 last quarter. During the quarter, we have repaid all our borrowings utilizing IPO proceeds and have become completely debt-free, which will result in higher PAT going forward. In respect of guidance for FY23, we expect to grow our revenue around 30% organically. In terms of EBITDA margins, we expect to improve our margins to around 12.5% for FY23 as against 10.3% in FY22. Our business needs to be looked at annual basis. Q4 is our strongest quarter, whereas Q1 is our weakest quarter, both from revenue and profitability perspective. The EBITDA will gradually grow from around 10% in Q1 to around 14% in Q4, which is an increase of 200 basis points each quarter when compared to annual basis. With this, I'll open the floor for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Praveen Sahai from Edelweiss Financial. Please go ahead.
Yeah, thank you for taking my question. So as you had guided for 30% of organic growth, can you a bit elaborate on your segment-wise? So like how much of the MarTech or distribution expected to grow organically?
So we have been giving guidance of DaaS segment growing around 15 to 20%, distribution 20 to 25%, and MarTech 50%. We don't see that mix changing. It will be the same mix.
Oh, okay. And second question is your hybrid, revenue contribution is increasing. So where you wanted to see this contribution to go?
I think look, hybrid and subscription are similar in nature. Hybrid is where we charge a minimum subscription fee and we also charge for excess usage. Right, so I would probably keep them in the same bucket, which is around a 75% subscription revenue. My growth will I'm expecting my market to grow, more than distribution business. The subscription revenue contribution will increase further.
So, is there any, the same customer moving to the hybrid? Is it like also happening like from your existing model, the person moving to a hybrid model, because that's a mix of both. So is it also happening?
No, the same customer is not moving to hybrid. I think hybrid is increasing primarily because of the increase in volume. So as travel is coming back, more people get more data like OTAs and car rentals and airlines. I think that's because of that. The hybrid percentage is increasing.
Okay, and one clarification, as the rate, the fare for airfare or the hotel room rate is increasing, is that also going to impact your revenue in positive way?
Our pricing model are not linked to airlines or hotel revenues. Just if you're talking about the ADRs, they are more linked to volume. So number of increase in number of bookings, that will improve our revenue, but not the average price increase.
Okay. Just a last question, sir. As you had mentioned, that's a Q4 being a strongest quarter. Can you elaborate that? Why is it so?
So the way the world travels, generally in Q1, generally all the travel plans happens in Q4. So the bookings happens majorly in Q4 for all, and also the Q4 is the first quarter of the budget year for many companies which are in US and Europe. So the spending happens more in Q1. So that's how we experience that our Q4 is always stronger than rest of the quarters.
Okay, it's more to do with the industry, travel industry.
Yeah, absolutely.
Yeah, I'll just add that largely in Q1 is when you think about leisure travel, a lot of the bookings happen for summer, and that's why we see that trend.
Okay, but as you are moving to the subscription or the hybrid model, so that will...
Yeah, the subscription hybrid model remains constant in terms of pattern. We might see some hike in subscription model when we see more wins in Q4. But from a transaction perspective, like we have 25% revenue dependent upon transactions, those are higher in Q4 than rest of the quarter.
Okay. Thank you, sir. Thank you for taking my questions.
Thank you very
Welcome.
much. Participants, we request you to limit your questions to 2 per participant. If you have any further questions, you may please join the queue back. The next question is from the line of Debotro Sinha from ICICI Securities. Please go ahead.
Thank you for taking my question, sir. Sir, I would like to know a bit more about the business. So, who are the target customers for your company? Is it the hotels or the travelers? And in case it is the hotels, like what segment of hotels are you targeting? And in case it is the travelers, is it domestic travelers or international travelers?
Sure. So we are a B2B company. So our customers are basically people who are either what are referred to as travel suppliers or travel intermediaries in the travel ecosystem that ultimately serve the traveler. So we don't deal directly with the traveler or the consumer. We provide solutions to these B2B companies which enable them to acquire the traveler, retain and engage with them, and have a wallet share expansion with them. So if you think about who our customers are specifically, it's these hotel companies, it's the airlines, it's the car rental companies, it's these intermediaries, which are the online travel agents, also tour operators, cruise liners, and now we also deal with vacation rental companies that you see on Airbnb.
Okay, thank you, sir. So one more question. So in that case, do you provide any packages, entire holiday packages, including traveling and lodging and everything included?
So we actually don't, we don't do the packaging, and it actually depends on the supplier. Are they using pre-packaged products to sell, or are they using, dynamic packaging on their own website? But what we do provide is the availability of rates and availability of the hotels that they can put together in the package through the distribution platform that we have.
Okay, sir.
Sorry to interrupt.
Yeah.
I would request you to please come back in the queue.
Yeah, I'll come back on the line. Thanks.
Thank you. Thank you very much. The next question is from the line of Nilesh Jetani from BOI Mutual Funds. Please go ahead.
Hi, good afternoon, Banu, and thanks for the opportunity. My question was on this MarTech business. So just when I was reverse calculating on average clients for FY22 and our earnings, the number comes at around $45,000 to $50,000 earning per client. So I wanted to understand, when we sign up, what is the bare minimum we ask for the client for the MarTech business? What are the opportunities to ramp up? So if client wants to increase its spending, does it impact our profitability in a better way? Or we charge just a fixed amount for the entire year, and then whatever client requires us, we just do the gross up and bill the clients whatever actual expenses are. Can you please explain that business?
Sure. So let me first talk through, what is the MarTech business and get into a little bit more details there, and then I'll let Tanmay step in and talk about, how do we price our offering. So, our MarTech offering is really, think about it simply put, it's an end-to-end digital marketing platform. And if you think about marketing, it enables you to do two things, right? It enables you to acquire customers or travelers or guests, and two, it does brand engagement. So we do this on, the entire gamut of digital channels that are available, whether they are social channels like Instagram, Facebook, Twitter, or, they're the traditional digital marketing channels like the Google, PPC, and in the case of travel, another important digital channel is what is called meta search sites. These are price comparison sites, which I'm sure most of you have used, whose business model is also like a Google model, which is an ad model. So we basically enable our customers to acquire guests and drive traffic to their own website through any of these digital channels. The second thing that we do in our MarTech platform is we also do brand engagement. As you know, social selling has become extremely important if you were to target the millennial customer. So we do a lot of brand engagement where we advertise and talk about all the new things that are happening at the hotel, what are the different offers that they have, and also monitor and engage with guests on a real-time basis as and when they put out commentary about the particular hotel. So it could be while they're at the hotel or they're looking, to book a stay where we are engaging with the customer. So what we do is we do offer each of these components at different modules, and the pricing of each is different. And I'll let Tanvi come in and talk about how different modules are priced.
Sure, Bhanu. So on MarTech, look, as Bhanu was talking about, like we cater to like Facebook, Twitter, and Instagram. So the customer can choose what level of scope of solution he wants to take. I think the $45,000 you talked about, I think what you probably have done is that you've taken the total MarTech revenue and divided by customers. But I think in MarTech we provide two separate solutions. One is the BCV solution and the other is the My Hotel solution. I think the average price is more relevant to the BCV solution, where the average price per property that we charge is around $25,000. But there are graded solution levels that they can get into. I think it starts with $15,000. Some hotels pay us even more than $50,000 to $60,000. So it depends upon what level of solution they take. And obviously, once they get in at a smaller price, if they want to avail more solutions, then the price increases.
Got it. That was really helpful. And my second question is on the overall margin. So in the initial comment, you said that the two high margin subscription-based business will grow in the range of 15 and 20% respectively, but MarTech will grow at 50. So how confident are you to taking our overall company's EBITDA levels to mid-teens in next 1 or 2 years if MarTech growth would come at a very higher pace vis-a-vis the SaaS business?
I think, yes, the MarTech gross margins are around 60%, which is at a pretty high level. When if you talk about a SaaS company, gross margin is around 63%. IT services company gross margins are at 40%. So even if I grow MarTech 50% year over year with a 60% gross margin, quite a chunk of growth will flow down to EBITDA, right? And obviously SaaS and distribution both are pure platform plays, and with a 90% gross margin, their growth will flow down to EBITDA. So as we're giving a guidance of 200 basis point increase year over year, that's what we're targeting to, and we're pretty confident about that.
But wouldn't sorry, one last question from my side, but wouldn't such growth in...
Sir, I would please request you to please come back in the queue.
Okay, thank you.
Thank you very much. Participants, please limit your questions to 2 per person. The next question is from the line of Prolin Nandu from GMO. Please go ahead.
Hi Bhanu and Tanmay. Thank you for this update on your quarterly and yearly performance. So 2 broad questions. One is on the operating matrix that you share, right, in terms of net retention rate and CAC to LTV. Or LTV to CAC. I just wanted to understand what is our aspiration, whom are we benchmarking against in terms of the numbers where we want to see these numbers in couple of years' time. And on this, I was a bit perplexed that our net retention rate of 120%, which we reported in 9 months, have dropped to 114% in the strongest quarter, Q4. So could you help us understand? Could you help me understand these 2 broad questions on your operating matrix?
So the benchmarks for SaaS companies for net retention rate is 115 to 120% is a good benchmark. As far as LTV to CAC is concerned, anything 3 to 5 is a great benchmark. But we are, in net retention, we are at par. In LTV to CAC, It's 12.9, which is much better than SaaS benchmarks. But considering many SaaS companies don't make profits, and we are profitable, so the 12.9 resonates well. I think it's at a very fair level. From a net retention perspective, I would love to increase that from 115 to 120% in future quarters. Your question of reduction in net retention rate is that, look, my gross retention rate is at 90%. It was around 91% last quarter. So we have not churned a lot. The factor is that we had some great new sales from which contributed to revenue growth. Both we had a very good Q3. It was the highest in the history of Rategain, and then we also had a very good Q4. So there are new logos that has been added. So that's probably is decreasing the net retention rate because if you see the churn rates are not gone down significantly.
But I'm sorry, but I mean, just on this, I thought that the new retention rate should not impact your net retention rate, right? Because that's old customer. Let's say he's giving you 100 rupees, without any adding anything, you would be getting 20 rupees, right? So I had a understanding that your new client acquisition should not actually impact your NRR, or am I wrong in that understanding?
No, I was answering from a revenue growth perspective, that why my net retention is around 114%, whereas my growth is around 46%. So I was probably answering from that perspective, but I think you're right. 114% is what the net retention rate is. We maybe I'll just recircle back with you with a
because why Tanmay I'm harping on this is that your 9 months retention rate was at 120. For you to report a full year NRR of 114, there has to be a significant drop in Q4. Is my understanding. So again, a bit if you can circle back, that would be great, right? I mean, on this number.
Yeah, I'll take your connect from SGA and I'll circle back to you.
Great. And second question, you have given a FY23 EBITDA margin expansion of 200 basis, right, in some sense. So slightly more medium-term questions on margin and operating leverage, right, in some sense. Could you help us understand, what are the levers wherein, we can increase revenue per employee, we can spread out the other costs, and how the depreciation and amortization will also normalize over the few years, right? Not in terms of quantity. I'm not looking for a number for FY24-25, but in medium term, in 2 to 3 years' time, how will these three major cost items look like as a percentage of sales going forward?
Yeah, so we currently, at the end of the day, we are still a very small company, right? And there is a huge market to tap into, and we can grow really fast. So we have been investing in our sales and distribution network, where we spend almost 20% of our revenue. We are spending 5% on innovations, which RG Labs Bhanu talked about, because we want to get more new age products which will propel growth. So those are the investments. Once the growth happens, those are the investments in terms of percentage of revenue will go down. Now, if you look at my revenue per employee, it has increased 17% year over year. In fact, pre-COVID, when we were around a 400 crore company, the number of employees we had was around 640 people. And today we have exceeded the run rate revenue by 8%. The annual recurring revenue is around 435 crore. We have only 606 people. So there is definite synergies that will come in when the growth happens. All the segment of costs, like we talk about SG&A or sales and marketing or investment into new products, in terms of percentage of revenue will come down when the when the growth comes.
Thanks, and I'll come back in the queue.
Thank you very much, Prolin. The next question is from the line of Sameer Dosani from ICICI Prudential Asset Management. Please go ahead.
Thanks for the opportunity. Just two questions. One, when I look at DaaS revenue on a Q-on-Q basis, we see there is a 20% degrowth on a Q-on-Q basis. Could you explain that? And second, also, when you look at gross margins, when I compare FY22 to FY21, there's a 3.5% drop in the gross margins. So can you just explain both these things?
I'm not sure about the first question, because what I see is if you're comparing Q3 FY22 versus Q4 FY22, I think there's a 5% increase quarter-over-quarter. At the end of the day, DaaS or any of the businesses have not declined quarter-over-quarter. Maybe if you have a different calculation, we can touch base offline. But from what I see or what the numbers I have is a 5% sequential increase in Q4. On the second question on margin front, I think I explained that also. Look, DaaS and distribution are steady growth businesses. We experienced a high growth in MarTech. DaaS grew 15%, distribution grew 20% this year, whereas MarTech grew around 100%. So there was a reduction in gross margin because MarTech is a slightly lower gross margin business than.
So only mix changes, you're saying?
Yeah.
And also, if I can squeeze in one more, what is the ESOP cost reversal? Is there an ESOP cost reversal in Q4 that we see?
Yeah, so there is a reversal because there's an unvested portion of exited employees that we have to reverse.
Okay, so going forward, this ESOP cost, what could be for FY23 or what would be the impact in FY23 for ESOP cost?
It will not be very significant as such. Most of the vested ESOPs, are vested, and we took those costs in the P&L last year when we went public. So this year it will be, maybe in the range of 2 to 3 crore max.
2 to 3 crores for the entire year.
Yeah.
Okay, that's it from my side. Thank you.
Thank you. The next question is from the line of Ashish Chopra from Goldman Sachs. Please go ahead.
Yeah, hi. Thanks for the opportunity. Two questions from my side. Firstly, Bhanu, if you could just share, you mentioned the LTV to CAC of 12.9. If you could just split that out in terms of what was your CAC last year compared to pre-COVID, and how should we expect that to trend going forward?
You're talking about the customer acquisition cost?
Yes.
Okay. 1 second. So we have been continuously seeing improvement in our LTV to CAC. Exact CAC, what it was during the pre-COVID levels, let me dig that out. But I think the one reason why the LTV to CAC has increased, I think it was pre-COVID level, LTV to CAC was around 8, and it has increased to 12.9 this year. I think a couple of things that is contributing to that is that we had a very large year in terms of new contract wins. We closed around 104 crore of new contracts. Last year it was roughly around 30-40 crore because that was COVID impact. But pre-COVID, we used to close around 60-70 crore or a $10 million range. So there has been significant increase in sales efforts with lower cost. As I talked about pre-COVID levels, we had more employees than what we have now. So the sales and marketing effort cost is lesser than what it is. I think one reason also factored in is that people are selling out of India or not traveling, so travel cost is saved, and we have kind of recognized the fact is that that can be an efficient way to sell. So that's how it has improvement happened.
Yeah, and if I may add, one of the other things that's happening at Rategain from a go-to-market perspective is, as you might have seen with other SaaS companies, there's a transformation in the whole framework where what is referred to as a product-led model, where you basically let the product sell itself. It's completely self-serve. So you see, you've seen it with likes of Zoom, etc. So, we are, I won't say we are there yet, but we are making now investments also in how we go to market. So instead of being the traditional sales model of inside sales coupled with marketing and feet on the street, we're trying to now become more and more of a product-led model, which from a GTM perspective is extremely sales efficient. And that's why you're seeing some of the benefits of that. And we'll continue to move in that direction. We're not there completely, but we'll continue to move in that direction.
So you're saying that these levels can be sustained going forward as well?
That's correct.
Got it. And my second question was, so when you mentioned that the organic growth in MarTech next year could be 50%, just to be clear on the definition there, so the business from My Hotel Shop, would you consider that as entirely organic, considering that it was not integrated for the full year in FY22?
No, we'll do an apple-to-apple. I'm talking about an apple-to-apple comparison. So if I'm consolidating 7 months of My Hotel Shop, we'll report 7 months growth only. Yeah.
Understood. So the reported number can be higher than as well.
Yeah.
Got it. That's very helpful. Thank you so much.
Thank you very much. The next question is from the line of Ranjit Gopal KA from HSBC Asset Management. Please go ahead.
Yeah, thanks for the opportunity. I have a couple of questions. First one is on the growth that you mentioned about 30% organic growth. So in terms of what we are seeing from a industry perspective, we've seen clearly recovery happening. So, in terms of our growth assessment, is it coming from the kind of contracts that we have signed over the course of FY22? Or is it more on the confidence of the trajectory of improvement that we are seeing currently? So if you can give some color on the growth that we are seeing, especially on the MarTech side, you mentioned about 50% growth. So how do you look at the color of the growth in FY23? Is my first question. Yeah.
Sure. So let me take this, Amit. So when we talk about, the growth drivers for FY23, see, one is just organically, now that we all know everybody's traveling, people are talking about revenge travel. So we're just seeing more volumes coming back. So when I talk about our DaaS business, we're seeing significant growth in our OTA customer segment. They just want more data. Similarly on our distribution business, as Tanmay pointed out, we're seeing a lot more transactions. And to your point, we did some very, very large deals in our distribution business, and I'm happy to report, a lot of those deals have now been monetized, and as a result of which, we're actually seeing transaction volumes, exceed pre-COVID levels in this quarter. The second thing that we are also seeing is these are seeds that we had sown last year that I talked about, RG Labs, and these are going to also drive growth, especially RevAI. It's been a great success for us within the car franchisee market, and we are seeing great amount of traction on our Demand AI product also. So we are also excited about, what these products are doing, and we want to continue to invest in sales and marketing of some of these new products, which we see huge growth areas for us. And we're also encouraged by the reception that we've had on these new products that, we are experimenting on some other product launches this year that we'll be able to talk about later in later quarters. And, something that I've always talked about is, we have a very, very large customer base. And, now that things have opened up, we are ramping our investments in sales and marketing in our market business and really focusing on cross-selling and upselling to our existing set of customers. So which should see, good growth. And, we were in a pause situation because US opened first, and then, as I pointed out in my opening remarks, now we see Asia and Europe has looked up also. And in this March ending quarter, we made significant investments in ramping up our GTM infrastructure also. So, we see all across, we will see as a result of that investment, additional go-to-market push as well. And specifically in our DaaS segment, we are also have now entered adjacent customer segments. We all know about vacation rentals that we look up on Airbnb. It's become a big market and it's very organized now. And we've had some customers, inquire and sign up on our DaaS platform. And similarly, we also are seeing a lot of interest by destination management companies on our Demand AI product. So there is an opportunity to get into these adjacent customer segments as well that should, enable growth.
Sure. Thank you. Thank you for the elaborate answer. The next question is on any inorganic initiative that we have planned for FY23, and will it be around MarTech? And amortization charge is around 23-24 for the past 2 years, and will it be actually it's on the similar lines for FY23 as well?
Yeah. So I'll let Tanmay address the second part of your question on the cost amortization. On the first part, just general, and I'm glad you asked that question. Generally, I'll give you some commentary on our M&A endeavor. So, when we evaluate, first of all, we run it as a proper program. There is a dedicated team, and we are constantly engaging with the marketplace for opportunities, and we evaluate opportunities from a lens of, 3 criteria. One, are these product capabilities that are a part of our overall product vision? 2, does it help us get deeper into certain geographies? So we want to continue to, get deeper in Western markets, US and Europe, and we continue to look at opportunities where we can, get more customers. And third, opportunistically, we want to look at competitors. Something that I've commented on earlier is for each of our business lines, we have different set of competitors. There's not truly an apple-to-apple comparison to Rategain because most of these are point solutions. So, we opportunistically look at those as well because, they can be very, very synergistic for us in terms of acquiring customers. And I'm happy to report that, given the overall environment, as you see, especially in the US NASDAQ market, that it's creating very, very good opportunities. So in terms of, market opportunities in evaluating companies, we've never seen a more robust pipeline. But at the same time, I will say that, we have demonstrated that we are very, very disciplined about what we are willing to pay. So the conversations are on, and there are multiple conversations, and they actually span all the criteria that I talked about. And these are all, related to the different lines of businesses we have. So I want to say there is more than one opportunity per business line that we have as we evaluate currently.
Thank you very much, sir. We'll move to the next question from the line.
I think there was a second question on the amortization cost, right? So, yes, I think the FY23 also will have similar amortization cost for FY22 as FY22. It will go down from FY24 onwards.
Thank you. The next question is from the line of Vishnu KG from Singular Capital. Please go ahead.
Hi, sir. Thanks for the opportunity. 2 questions from my side. First, on the market business, could you call out the number of properties at the end of the fiscal year? And over the next 3 to 4 years, how do you see this panning out?
bit muffled.
Is this better?
Yeah, if you can go ahead now.
Yeah, sorry. Yes, sir. So my question was, could you call out the number of properties in the MarTech business at the end of FY22? And related to that, over the next 3 to 4 years, what is the number of properties that you think that we can target properly? And second, more bookkeeping question, your working capital seems to have swelled in FY22. Anything particular to call out? Thank you.
The first question was in terms of number of properties, right?
Yes, sir.
We are talking about all the business units or any particular business? Actually, it was not very audible.
So just on the MarTech business, the number of properties over there.
MarTech business, okay. So, there are like, we have got two segments in MarTech business now. We got BCV and we got My Hotel Stop, which is in Germany. BCV is close to 375 properties today, and My Hotel Stop is close to around 800 properties today. So was that the question? Did I answer the question in the first part?
Yes, sir, yes. That was the question.
Sorry about that. Vishnu, actually your voice is very muffled. If you're using any earphones or external device, you can remove that and please go ahead. Or maybe you can email your questions because it's not very audible.
Sure. We'll do that. Yeah.
Thank you. We'll move to the next question from the line of Sanjay Avadramani from Envision Capital. Please go ahead.
Yeah, good afternoon, and thank you for giving me this opportunity. Sir, as you just given the answer for properties in the MarTech business, so in the last Concall you mentioned that in the MarTech business we have 400 properties, and in the short term we are planning for 1,000 properties. So can you clarify, how are we moving ahead in this, and what is the number we can expect in the next 4 to 5 years down the line? What are the properties we are expecting to be in with us?
So yes, so you're right. So what we've seen is, as we're going through, and thanks to the education we're getting from public markets, there is a very, very large focus on margin expansion, and as a result of which, in our MarTech business, we saw there were some deals done because of the COVID situation at deep discounts. So as a result of which, as we look to expand our margins, we decided to let go of some of these properties, and now we are very, very focused on ensuring that we uphold our prices and continue to, actually expand on our prices so that we can have a margin expansion. So, we saw a great addition to number of properties, but at the same time, we did have attrition of properties as well. As I mentioned, there were some, low priced property engagements that we had. Our target continues to be to get to, all across. So our first target is to now, as I mentioned, our MarTech business is about selling both on social channels, which is BCV and social engagement, and two is also selling on digital channels. So our first target is to now have a much, much larger, cross-sell, upsell initiative where we can get hotels to be across both the platforms. And, overall target continues to remain, to get to 1,000, but at the same time, like I said, we are now extremely sensitive about driving our margins higher. So we've, calibrated our efforts to focus first more on, getting our margins to be higher, and driving, sustainable growth forward.
Okay, this is very clear, sir. And last thing from my end, that for FY23 you have given a target of 12.5% of EBITDA margin. Is this correct? And the second thing is on Q4 you said that you'll be hiring some senior team members or team leaders. So what is the margin impact for this on Q1?
No, I think the Q4 we registered 11.7%. What I talked about is that we were expecting 50 basis point lesser margin because there were some new positions that could not be filled up and probably spill over to Q1. But I think, as I said, like Q1 is in terms of revenue and profitability, it's lesser than Q2 or Q3 or Q4. So we're expecting around a 10% margin in Q1 and gradually increasing so that we average out around 12.5%.
Okay. Hello.
Yeah.
Yeah. Thank you so much, sir. And the last one is that MarTech is a high tech point business, and as we work on pitches and we need to be on the ground. So are we working on some campaign tweakings, and what is the scaling? How will we manage the people which will be required for this MarTech business?
Sorry, can you repeat the question?
Sir, I'll repeat my question. MarTech is a high touch point business, and as we need to work on pitches for the marketing campaign, basically to manage the marketing campaigns or tweaking them. So this will require a large team on the ground, right? And plus we do require, unique campaigns to attract people on the Rategain platform or for the customers which we get on board, the hotels and the other intermediaries which we spoke about. So how we are planning to manage the scale, or how many people will be required in the future to move ahead with this MarTech business?
Yes, correct. So that's a great observation. You're right. This is a more managed service part of our business versus being, completely a platform play. So, the analogy that I usually use is we provide the platform or the car, but we also give you the chauffeur or the driver to drive the car. So, our goal is to do two things really. One, we want to continue to stitch together everything that we have into one platform and make this platform a lot more intelligent. That's across the industry, because we are able to have a lot of these nuggets. Like, we know how travel demand is trending. We know how your competitors and your distributors are distributing their price. So all that information is absolutely critical in driving a much, smarter ad spend so that you can drive a much better ROI. So the fact that, we are the only company that can pull all of this together thanks to the integration of DaaS and distribution components, we see that the value that we can charge on each of these customers, we can continue to drive much higher ticket price as we sort of move forward and stitch all of this together. Now, the second thing that we are really focusing on is, automating and productizing, some of these managed service elements such that, the number of people is not completely linear to the number of hotels that we had. And we're happy to get offline with you and provide you some statistics where we are seeing, the number of people, the number of hotels that each team member can support is increasing as we look to automate and productize a lot of these tasks.
Thank you. Sanjay, I would request you to please come back in the queue.
Okay, thanks.
The next question is from the line of Karan Uppal from Phillip Capital. Please go ahead.
Yeah, thanks for the opportunity. Bhanu, one question is on the if you can provide any color on the new products which you have launched, Rev AI, Demand AI, and Content AI. What is the market response from these new products, and any contribution you are expecting in the 30% organic growth guidance which you have given?
Yeah, sure. So very quickly, what Demand AI does is basically gives you a sense of how travel demand is in any particular market. So think of Delhi, and we will say in the month of June, we give it a score on a scale of 1 to 100, that travel demand is going to be, let's say, 90, which means it's going to be high. And using that information, hoteliers can do two things. One, they can decide, how they want to price their product. If the demand is going to be high, they can increase the rates. And that's what we are seeing across markets, right? Because the demand is high, they're increasing rates. And B, they can also plan to optimally staff up, their hotel. And three, it's also useful information on how you do your sort of digital marketing. So we're seeing some very, very good traction on demand AI. As I mentioned earlier, we signed up one of the largest hotel chains in Spain. We've also signed up, a lot of these that I referred to DMOs. Think of Visit Dubai, Oman Tourism, all these, big tourism boards that are supported by the different governments to attract tourists. We're also keen to understand how travel demand is, working out in their area. So it wasn't, something that we targeted, but incidentally, it's taken a huge liking by a lot of these DMOs. In fact, we are also seeing as big events happen, the tourism boards of those events, whether it's FIFA or World Cup, also showing a lot of interest. So it's opened up an adjacent segment for us. And on Rev AI, what it does is it takes demand AI and our competitive intelligence solution from that and puts all of it together and goes one step further and makes a recommendation on how you price. So we actually tell our customer how they should price. So you guys are going to hate me, but if you're seeing increase in prices, maybe some of it is as a result of people using Rategain software, because we see there is increased demand but not as much inventory, and we recommend our customers to increase. So we're doing that we deliberately decided to go after the car rental franchisee market because we see that as a white space and greenfield opportunity. And, I'm happy to report just within the first year of launch and just 6 months of marketing, we signed up about $1 million ACV in Rev AI. And then Content AI is a content distribution management and content augmentation tool because, what hotels also, as I talked about, are suffering from this great resignation. They're unable to provide updated content on what are health and safety protocols. Now there's a lot of talk about sustainability. We've provided an automated tool through which hotels can update content with their third-party partners and also enhance the quality of the images. So on all these products, we are at different stages of evolution. I would say Rev AI is where we have seen, great traction. And I think we're in the, final stage of getting to having the product market fit before we start to scale. In terms of the 30% growth margin, the growth percentage, what contribution this would have, I'll let Tanmay comment on it.
Tanmay Das, are you able to hear us?
Yeah, I actually missed the last part, the comment 30%. Sorry, Banu.
Tanmay, what is the contribution of the new products in our revenue growth in the 30%?
Yeah, it will be roughly around 4%.
Okay. Yeah. Okay. Thanks for the detailed answer. The second question was on your transaction business. Right now it is around 24-25% of the overall revenue, but with a very strong demand, travel demand, which is there currently. So can this transaction business go up to maybe 35-40% of revenue at the end of FY23?
Well, if obviously if the demand goes through the roof, obviously we will be beneficiary of that, but I can't predict that today.
Okay.
Thank you.
And just last one bookkeeping.
Sir, I will please email it.
Okay.
Thank
Sure.
you. The next question is from the line of Manish Dhariwal from Fiducia Capital Advisors. Please go ahead.
Thank you very much for this opportunity. I had one question on the working capital position of the company, which, when I look at the trade and other receivables shooting up, and also some significant write-offs. So you have some color on that. And my second question was that, how many properties, we have some 2,400 companies that we are working for. So how many hotels does that translate into? So you've given some numbers on the MarTech side, but then on the total thing, if you could just give us a flavor.
Yeah, sure. So taking the first question, look, the working cap, we have had a large quarter in terms of revenue. The revenue increased by 51%, which is around a 36 crore or 37 crore increase in revenue against the last quarter of last year. So we have a large debtor balance that was accumulated because of the billings that happened in Q4, which is getting collected in Q1. Which is, if you talk about a percentage of revenue, it is the same for last year and this year. So that's fine. The question on write-offs, if you see, the last year it was higher because of COVID year. We had to give discounts, waivers, and all. We had some slippage to this year of those, which we have taken care of now. But I think it is generally in a good year it is around a 1% of revenue that we experience as write-offs. In a bad year it's around 2% of revenue that we experience. I think the COVID year has been a little bit slight higher, but this year it is within that limit, and we expect to. We now cleaned up all COVID-related issues now, and we expect to improve it further next year. The other question you had was on the properties. Look, it's different in different segments. For example, a distribution segment, we have got the Marriotts of the world or the big chains of the world who have connected to multiple hotels of theirs. So distribution segment itself caters to around 130,000 hotels. But not all hotels might be producing because they're connected with us basically. On that segment there will be around 3,000 properties with us. So in total, if you're talking about, I think we connect or provide solution to around 140,000 odd hotels.
Wonderful.
Manish, thank you very much. We'll move to the next question. The next question is from the line of Rahul Jha from Bay Capital. Please go ahead.
Yeah, thanks for the opportunity. Can you give us how much revenue was contributed by My Hotel Shop for the full year and for this quarter? And secondly, on the MarTech new client addition, what portion is due to this acquisition of My Hotel Shop and what is organic?
Overall basis, as I talked about, we grew 46% year over year, right? And if I just take out MarTech and My Hotel Shop, then we grew around 30% organically, and 16% was contributed by My Hotel Shop. If that answers your question.
Right. And for the new client addition in MarTech?
The 104 crore we had because we acquired the company in October and there were 3 months of cross training and all. So there was not a very significant amount of new sales from my Hotel Shop recorded. It is primarily the existing client expanding, the growth came in. So yeah.
And on the receivables front, I see that some 16-17 crores receivables have increased. But actually, if you look at quarter-on-quarter, if you look at, say, from December 21 to March 22, receivables have increased by 17 crores, but your revenue has actually increased by 7-8 crores. So what is really happening here?
Well, obviously, the increase against December 21, so we grew around 9% sequentially, and that is a 7 crore increase, right? So the DSO of the company is around 80 days. It went up to 105 days in the COVID time. In pre-COVID, it was around 60 days. So it has obviously gradually decreasing from 105 days to come down to 80 days, and it's going to further decrease on that. There are certain large clients where we have agreed for a extended pay period, which still continues, and we're trying to negotiate to bring it down further. But as long as we reduce the DSO going forward, the situation will improve further.
Thank you very much.
Thank you.
Due to time constraints, this was the last question for today. I now hand the conference over to management for closing comments. Mr. Bhanu Chopra, you may proceed with the closing comments.
Yes, I just wanted to thank everybody who could take the opportunity to participate on the call today. I hope we've been able to give you a good overview about our company, insight into the performance thus far and the growth story that lies ahead. Moreover, I hope we have answered all your questions appropriately. And if there are anything that anybody else wanted to ask, please feel free to contact our partner SGA, and they can relay the questions to us, and we'll be happy to also jump on a call if required. So thank you, everyone.
Thank you very much.
Thank you very much.
On behalf of Rategain Travel Technologies Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.